Hello, you traders. This is King de Mesa from Unicapital Securities. I'm a research analyst currently covering property, telco, and gaming sectors. I've also covered the power and oil sectors in the past. And we're going to make a webinar, a market update webinar for today titled Lockdown Impact Taking Major Swings to Earnings. We will make this quick. We don't want to take much of your time. And to start, for our agenda, we're going to be talking about index and index stocks performance for one. Second one is company earnings for the second quarter and the outlook for the third quarter, as well as the top upsides based on our coverage, strategy, and summary of this presentation. First off, we ought to look at the performance of the PSEi. As you can see, year-to-date performance is still down 24%, and we believe this was because of the rise in new cases in the coronavirus. Right now, we're doing plus 2,000 to plus 5,000 per day, so that's very bad for our market. And we think that the weakness is expected to persist again due to the rise in new cases, as well as poor earnings outlook for the big companies listed in the index. Also, GDP slump, which we saw GDP of the Philippines declined by 16%, 17% during the second quarter. And high unemployment is also seen going forward. Last time, the PSA reported about 17 or 18% also of unemployment. This would result, of course, to lower income for households, which would lead to lower spending. And ultimately, this will affect our economy since consumer spending consists around 70% of our GDP. It made a run to 6.5 during May. Yes, during May, it made a run to 6.5 on lockdown easing because during that time the ECQ was lifted. Most of the places here in Metro Manila was placed under GCQ from ECQ or MECQ. So there's optimism shown in the performance of the PSEi during that period. But again, it was down from 6.5 to 5.931 as of today. And this was mainly because of the very fast increase in daily new cases in coronavirus. Looking at the sub-indices, as you can see, the drag was mainly seen from the financials index. These are banks, of course. They will be directly hit because loan provisionings in their books will be much higher in anticipation of loan defaults because of lower business activities and challenging environment. This would also mean that the market is expecting very bad earnings from our banks. The second most down, if I should say, mainly because of the lockdown, was the property sectors. As we know, the lockdown would mean the construction halt, which means lower revenue bookings for these property companies, which again would result to lower earnings for the coming periods. It has also limited mall and hotel operations, so the office segment is only the segment that is not really affected by the pandemic because of sustained operations of BPOs and traditional businesses. But again, overall, the property sector is expected to post very bad earnings during the third quarter. And going forward, at least for this year, we do not expect good earnings or good numbers from these property companies. Some might even register losses because of the lockdown imposed by the government to contain the spread of the coronavirus. Overall, the PSEI was down 24% year to date. For the members of the PSEI, as you can see, Tel was the highest gainer among these stocks based on a year-to-date performance. Again, because the telco industry is one of the favorite industries as of now because of its resilience to the coronavirus. Again, because people are expected to still use internet and demand more internet services or data services because companies adapt work from home schemes, which would mean that they cannot do their job without data or internet connectivity. So, in terms of earnings, the market is expecting pretty good earnings relative to other sectors. That's why Tel was the highest gainer year to date. Also, trailing was Globe and P Gold, which are considered essentials again. And as you can see in the chart, EMP or Emperador was also one of the highest gainers, mainly because it was added in the index in replacement of Semirara coal mining. Yeah, so you can also observe to the far right that most names are banks and property companies or holding companies exposed to banks, property, or infrastructure, mainly because of expectation of bad earnings because of the lockdown. Now we go to the sectors. First of all, banks. The second quarter earnings saw a significant decline on higher provisions due to lower business activity caused by the lockdown. However, notable were SEC B and EL or Security Bank and East West, which recorded higher year-on-year earnings due to higher trading gains despite recording record provisions during the second quarter. For going forward, recovery can be seen in other income such as fees and commissions amid the easing of the lockdown measures during the third quarter. But banks will continue to increase its buffer against loan losses, meaning more provisions will come during the third quarter or the fourth quarter this year. But this would be less aggressive compared to the second quarter. And lastly, there is still some legroom for trading gains should banks decide to further unwind their investment securities portfolio. But the bottom line here is that we can expect further provisions in the third quarter, which would ultimately affect their earnings. So, pretty bad expectations still for banks during the third quarter. For the consumer, um, as we know, restaurants suffered the most. As you can look at it, the graph, you can see JFC having the most impact or being the most hit. Restaurants suffered the most, including JFC, Pizza, Maxes, as stores were forced to close during the strict lockdown. But some names, including groceries or manufacturers of essentials, recorded higher earnings, including P Gold and URC. There's an imminent rebound in economic activity to trickle down the sector as consumers can can buy their products amid the easing of the lockdown during the third quarter. We can see some recovery in dine-in sales for third quarter compared to second quarter, but this would likely dampen or this would be likely dampened by the imposition of 2-week MECQ in Metro Manila, But still, we could expect a better sales for third quarter compared to second quarter of this year. Also, the resumption of mass transpo, although at a limited capacity, could benefit these consumer companies moving forward. But again, bottom line, further lockdown would mean more lost revenues, which would translate to worse earnings or bad earnings moving forward. For the property, as you can see in the graph, earnings across the board declined significantly, with SMPH and Ayala Land being the most hit in terms of if you look at the earnings during the second quarter. For residential across the board, revenues, of course, were hurt mainly because of lower revenue bookings since construction activities were halted during the lockdown period. So they cannot book revenues because they cannot progress with their projects because revenues are recorded as a percentage of completion of their project. So if you cannot or if they cannot construct their projects, of course they cannot record revenues. So that's why the residential revenues were the main drag for all these property companies during the second quarter. Also, one of the main drags were malls and hotels, which which we know has limited operations only because of the lockdown, and also these property players gave rental waivers, meaning um, they gi- uh, they 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 totally will not receive rental payments from its small tenants as a way for them to help their merchants. So it was reflected in the second quarter earnings, and that resulted in a main or that resulted in a big slump in revenues and affected their earnings during the second quarter. And also, people are scared despite opening of malls, of course, because um, the rise in new cases continue to be fast. And as of now, we are recording around 2,000 plus a day in the additional cases in the country. So that's a bad signal for people. Um, that's not a good sign for these companies because if people cannot go to their malls, they cannot earn, and of course, the merchants of these property players will suffer, which could which could mean that they cannot earn anymore and probably end their contract with these property developers, which would mean lower earnings for these players moving forward. For the office, the office segment is um, the only one who recorded strong earnings in terms of the property segments, but the strong revenues or the strong revenue growth during the quarter were not enough to offset the decline in other segments. So bottom line here is that we can still expect weak earnings during the third quarter, especially due to the reimposition of lockdown during the month of August. So still a pessimistic outlook for the property sector. For the telco sectors, the second quarter earnings were modest since people relied on data services amid the lockdown period. So we are expecting a modest earnings also during the third quarter as individuals continue to demand more data services. And one catalyst for earnings could be the subscriber base from the fixed line business could hit double digit growth this year. Also, we continue to like the telco sectors because of its defensive nature in the context of the pandemic. And also, Globe and Tel has or have attractive dividend yields. So this is a bonus if you would want to invest in the telco sector. But again, we're expecting modest earnings growth only for the third quarter. For the power sector, um, as we know, factories, manufacturing sites, malls, hotels, and other establishments were closed or only have limited operations, which resulted in lower electricity demand. For the second quarter, most of the utility companies in the power sector experienced significant decline, as you can see in the table during the second quarter, with Semirara Coal having the highest decline at 71% during the period. And this was mainly due to the lower electricity demand from the commercial and industrial segments because of the disruptions caused by the pandemic. The increase in demand from the residential segment slightly offset, but still not enough to record earnings growth during the period. But we can expect quarter on quarter basis a strong rebound for the third quarter, driven by the recovery of power demand amid the resumption of business operations in the third quarter. For the cement sector, earnings dropped across the board as construction activities were halted, again resulting in lower demand for cement. Q2 earnings was largely dragged um, by muted construction activity, and we expect margins to remain challenged for the rest of the year because of competitive pricing schemes um, resulted resulted from the lower cement demand for the period. But similar to other sectors, we expect the cement sector to recover at least a little or a little recovery in the third quarter compared to second quarter. Again, as the government eased some lockdown measures during the third quarter. For the gaming sector, um, this sector is one of the hardest hit. Earnings turned into losses because the government totally shut down casino operations. Um, this is this is very bad for the gaming sector because almost 80% or 90% of their revenues come from casino operations. So, of course, during the second quarter, they totally shut down the casino. It means virtually zero revenues for that period. And as of now, it's still not open. So, we can expect for the third quarter to record the same in terms of earnings unless the PAGCOR signaled that these gaming operators can finally operate their casinos anytime during the third quarter. But if this shutdown of casino operations will persist moving forward, we can expect the third quarter and fourth quarter to record the same earnings drop or or not even earnings losses for the subsequent periods. For the infrastructure segment, again, there are three. We are monitoring three largest infrastructure player in the Philippines, which are MY, EEI, and DM Consunji, or the construction arm of DMC. As you can see in the graph, earnings also turned into losses with construction activities halted during the second quarter, which resulted in lower project bookings or revenue bookings. They record revenues almost the same as, or I should say completely the same as the property players, wherein they record their revenues on a percentage of completion basis. So again, if they cannot work on their projects, they cannot progress, they cannot record revenues, and that turned into losses in terms of the profit and loss statements of these infrastructure players. So again, the slow resumption of construction activities would still hamper the earnings for the third quarter. And the longer the lockdown period, again, the harder the construction or infrastructure companies to earn, which could lead into the risk to their cash flows. So pretty much M-Wide was the hardest hit because it's a double whammy, since it also operates the Mactan Cebu International Airport. As of now, travel restrictions are still in place, so they cannot earn from their airport, and at the same time incurring costs. So that was a double whammy for M-Wide. For oil, as you can see, PECO recorded 9 billion, almost, 9 billion peso losses during the second quarter, mainly because of lower oil demand. And because of the lockdown, people cannot use their cars or go somewhere. So that resulted in lower oil demand during the period. Almost all oil companies listed in the Philippine Stock Exchange, including Phoenix, Pcor, and Shell PH, posted losses. And we expect that this would continue moving forward because oil demand is not yet back at its pre-COVID levels. And as you know, Shell PH is shutting down its oil refinery mainly because of unproductive uses, because of lower oil demand, and this will be turned into an import terminal. So Shell PH will be venturing into a new business model, same as Phoenix. That's how bad, or that's how hard the coronavirus pandemic hit the oil sector here in the Philippines. So expectation for the third quarter, the same, um, soft performance for the sector, and we're quite pessimistic on oil as of now. Moving on to the what stocks to look for or worth looking for. So as you can see in the left table, it's titled Resilient Stocks. So these are stocks which we think will be resilient in terms of earnings despite the coronavirus pandemic that's happening right now. You can see there Globe, Tel, and P Gold, with Globe having 11% upside based on our coverage. So the strategy mainly for these stocks is to wait for the prices to go down for better upside, because we all know that these stocks or these businesses will perform better than its peers, or I should say the telco and the consumer retail would perform better compared to other sectors. And under those sectors, we like Globe, Tel, and P Gold. So the strategy is to wait for prices to go down for better upside. Going to the right hand most table, you could see high upside stocks. So these are stocks covered by us, which has the highest upside as of this week. So you can see number one is Metrobank, BDO, AP, SECB, MEG, BPI, JFC, and MER. So you can observe that most of these stocks are from banks, mainly because they have declined so much. They are at a deep discount relative to their multiples, which means simply that they are very cheap right now. That's why they have a very huge upside, as you can see in the table. So the strategy for these stocks is to accumulate for the long term, because we are expecting these stocks or these businesses to recover once the coronavirus pandemic has subsided. And right now is a good strategy to accumulate these stocks while they are still cheap or very cheap. So again, accumulate for the long term and be patient. We think that the reward for these stocks would be substantial, as you can see in the upside. For the strategy, again, we recommend to deploy a less aggressive approach, mainly because earnings outlook are still pessimistic. The third quarter will likely make, or the third quarter earnings will likely make the weakness in the market persist. So again, as I've said a while ago during the early part of this presentation, the index is experiencing weakness mainly because of a poor earnings outlook for the companies. Second one is to prioritize companies that are resilient during the pandemic. Again, we continue to like the telco sector and the grocery or essential consumer sectors, namely Globe, Tel, URC, Pure Gold. Those are the names we like as of now. But we are stressing that you prioritize the resilient sectors or the resilient companies first before risking your money into other sectors that you think will perform good in terms of stock price and in terms of its earnings going forward. And lastly, of course, always exercise proper risk management. Only use long-term money. Always think long-term, because this pandemic is here to stay. It's not gonna be gone by tomorrow, by next week, next month, probably next year or next 2 years. So always exercise proper risk management to avoid losing your money. Always think long term. Pick stocks that will continue to grow 2 to 3 years from now. And if you are a risk averse investor, you should preserve cash or maintain substantial amount of cash relative to your investments in stocks. As a summary, most of the companies, as we have discussed a while ago, recorded significant earnings drop or even recorded losses, mainly because of the impact of lockdown measures to fight against the spread of COVID-19 in the country. Essential sectors remained resilient, while the hardest hit continue to suffer. Again, we recommend to pick resilient sectors to minimize your risk. And lastly, this is not the time to be aggressive in the market. Be patient in buying fundamentally sound companies. Employ risk management. Think long term to avoid losing your money. And to always try to monitor the market regarding updates. And that's pretty much it for this presentation. So thank you. We hope you stay tuned because we are doing market update webinars every month. So you should stay tuned to be updated on what's happening in the market, in the economy, which would affect your investments going forward. And that's it. Thank you. Thank you, you traders. Happy investing and stay safe.